All right, welcome everyone to another episode of Pitch Deck Insights. I'm your host, Litan, and with me is my good friend, Mike Arndorfer. And today we're going to do something a little different. We're not going to analyze a pitch deck, but we're going to dive into some fundamentals from a terminology perspective that we think is important for everyone that's interested in becoming a better investor, understand. And there's a lot of mess in the industry. So I thought we'd do that. Mike, does that sound good?
Sounds great.
All right. So I think one of the important things we want to talk about this time is what you're actually investing in from a terminology perspective. So we see decks saying it's a multifamily deal, or it's a single deal, or it's a fund, it's a feeder fund, it's a fund of funds. And we didn't really have time when we went through the previous pitch decks to go into that, what that even means. And I think there's a lot of ambiguity in the market about people look at it differently. If I've heard people talking about, we're raising money for a fund to invest in an asset, a single asset, or, I'm raising money for a fund of funds that's going to invest in one fund. It's all like counter to what it means. And so I thought we'd talk about that. What do you think about, I think the foundation of it is a single deal, right?
Yeah, which I would typically call a syndication or some sort of single deal, or it could be multi-asset, but you know exactly what it is ahead of time. It could be a 2-pack, 3-pack, one deal, but they already have it tied up. You know exactly what you're buying into, and you can do the underwriting on that specific deal to decide if you want to invest or not. And then all of your money is going into that one building or one property or whatever they're buying.
Right. But I think it's important to emphasize it's a single deal, right? If there might be a pitch deck talking about the acquisition of multiple properties that are already predetermined what they will be, that is not a syndication, that's a fund, right? Because all those properties will be held under the same, or multiple organization, but the same investment vehicle, which is a fund that holds multiple assets under it. So even though these are already predetermined, it's still a fund. I think when you raise...
Predetermined and sometimes not. It really depends on where you're at in the process. So sometimes they'll bring it to investors in the very beginning with a seeded deal or two, where they've already purchased something and you can kind of get an idea. But a fund, they should be telling you what their plan is. We're going to buy, 8 to 10 mobile home parks, or we're going to buy 5 multifamily and what it's going to look like and that sort of thing, where they're spelling it out. And sometimes you don't have any more information than that, and then a little bit of their track record and what they're doing. And other times you'll know some of the assets, especially if you're coming in late in a fund. Because I've seen funds raised for, I don't usually like them to go more than a year, but I've seen them 18 months, 24 months even, where they're raising over that period of time. And so you have a lot of ideas.
All right, but hold on. Before diving into a fund, let's still stick to like the single asset, which is like the basic of like what you call syndication. And so a single asset is a single asset. Once there's more than one asset, it is no longer a single asset deal. It becomes a fund. Now, there are different types of funds, and we'll touch on that in a second, but I think it's important to emphasize what that means. There's a single asset, there's a GP, an operator, and we're going to touch on all those terms as well at some point.
Yeah, I may be thinking about this wrong, and not that, I think that you can still be a syndication and have 2 assets. So I'll see that sometimes where an operator will bring 2 apartments together that are in the same market, or for some reason they somehow balance each other out, or they're helpful together. And the thing for me is, in a syndication, you know exactly what you're buying, and you can go through their underwriting and look through that and see if you're comfortable with their assumptions beforehand. Versus, to me, a fund, one or more of the deals that they're buying, and oftentimes most of them, you don't have any idea. They just tell you the plan, but you don't have any specifics on what exactly they're buying.
Right. So basically what you're saying is a portfolio of assets is not a fund in your mind.
In my mind, it's not, because I know exactly what I'm buying ahead of time. And again, maybe it's called a fund and that's what it should be. But in my mind, that's different, because I know exactly what's being purchased and I can underwrite those specific deals. Usually it's just one, but every now and then you'll see somebody that they'll call it, they'll bring 2 or sometimes even 3 assets that are similar that they're getting all at the same time. And I would still call that, I don't know, maybe you still call it a fund, but to me, it's because I know, and it's usually one asset. It's not. But yeah, I think you may be right on what you call it with that, but I see them differently. The fund is where I don't have knowledge. I really am just trusting the operator, that I know their plan, and I'm trusting them, and I'm trusting them to stay within their buy box and buy these things as they're saying. And I'm just saying, yep, I'm on board with you. I trust you. Let's go.
I think this is a really interesting question. And, when you talk about it more, it gets me thinking a bit about my own definitions of a fund versus like a portfolio. Because when you invest in a portfolio of assets as an LP, and then one of those assets sells, or there's a refinance event, you will get a lump sum of money as an LP in that fund or in that portfolio, right? right? Whereas if you invest in a fund, it doesn't matter if they were predetermined or not. Let's just say you invest in a fund and that fund starts to deploy capital, building a portfolio of assets under the fund, and then an asset under the fund is sort of sold, exited. Is it treated in the same manner as it would if it was a similar portfolio?
It does if there's sort of defined term funds where it's things where like, we're going to buy these 5 assets, or we're going to buy 20 assets and that's it. And then we're cutting it off. So this is fund 1, fund 5, that kind of thing. You know exactly what's going to go in there and you're going to fully participate in all of the assets as they sell. I'm in a fund where everything's been purchased and the plan is to hold for 5 years, but there's 1 or 2 assets that are either doing really well and they're getting an offer that is interesting for them, that they like, now's a good time to sell, or there's one that's not going as well and they can just sort of get out of it and move on. So they'll sell those and I'll get a portion of that money back, a portion of my proceeds for it. What the difference of a fund though is if you get into an evergreen fund and then they're just rolling it and it's one of these.
Hold on. Let's not go into that
asset value, but that's where I'm not getting anything specific from that necessarily. And they're redeploying the funds and all that. That's a whole different thing.
Yeah, but I've invested in a portfolio of multifamily assets through a syndicator, an operator. And when one asset was sold, I got the money back. And then another asset was sold, I got more money back. But I was still getting distributions on the other one that were cash flowing. Whereas a fund, it feels you have shares in the fund and then that share has some sort of NAV, some sort of value to it. And then there's a distribution based on the number of shares you have in the fund, based on the profits of the fund overall.
I typically see an NAV in a multi-year evergreen type strategy. I usually don't see an NAV that I can think of in most things. Even if you get into private equity or something like that, what they'll do, if they'll say what the current value is, let's say that you're coming in 18 months in and they've created 20% value in the original money that came in, but now they're going to raise more. They'll sometimes do that where you're buying at 1.2x of what the other people bought in at because they're just trying to come up with the current value, but it's not really a share. Because then if they sold one of those, all the original people and the new people would get a portion back.
No, well, then they define different classes of shares in those cases. Yeah, I guess that's something we need to look into.
I think of what you're describing, there's 5 assets and you start out with 5 and then as they're kicking off cash flow, you're getting it. And then they sell one and you get some money and now you're getting it off the other 4. They sell another one, you get some more money and you're getting it off the other 3. I see that as a fund. That's just a defined fund where it's those 5 assets. And you have ahead of time exactly what those 5 assets were, or it may be something where they only knew what 1 or 2 of them were, but when you put your money in and the rest got purchased afterwards.
So let's simplify this, all right? So a single asset, there's a GP raises money to acquire a single asset. You are part owner in that single asset through the LLC as an LP, whatever it is. That single asset throws off cash flow. And after a certain amount of time, there's either refi or exit event, and then you're done. No longer relationship with that GP. Anything that involves more than one property, could be a portfolio, could be a fund. Let's just put that under the same bucket. As long as the entire portfolio, the entire fund, as it's just say a closed fund, not evergreen fund, ends and everything's liquidated, only then you finish your relationship with that fund and that GP. So let's just call that like the difference between those two.
I really don't know. When you get in, they tell you what they expect the IRR and the equity multiple to be, but you really can't calculate it until that very last amount of money comes out and the final thing sells. That's when you can really look back and say, oh, this is what our real IRR, this is what our real equity multiple was.
Right. You just look at the cash flow from the exits as basically cash flow, just like you would a distribution, only larger lump sums. Then you calculate your IRR at the end. All right. So we spoke about a single deal. We spoke about a multi-deal, and let's just call that a portfolio or a fund. Now there's another term that's called, a feeder fund. How would you define a feeder fund?
Well, there's 2 kinds. There's a feeder fund where you know what you're getting into. A lot of times you'll find an investment that is $1 million, $2 million, $10 million minimum check to get into. It's sort of where the big boys are going in. And you'll sometimes somebody will create a feeder fund, or you can create an LLC, a special purpose vehicle LLC, to join forces together as a group and be able to get into that. So that's what I would consider a feeder fund, where you know what you're getting into and you know exactly what they're investing in, versus there's other feeder funds that are what I would call a blind feeder fund. And there you're just saying, hey, the person running the feeder fund and telling you, you don't really know what you're doing. I do know what I'm doing. I'm really good at due diligence. Due diligence is really hard. You're going to screw it up. Give me your money and I'm going to get better. I'm going to find good deals. It's going to be safe. So I'll protect you. And then also, because I'm bringing in bigger check sizes and kind of aggregating things, I'm going to try to get special terms, because either way, a feeder fund, you're usually paying a second set of fees. There's the initial fees that the big fund has, and then the fund of funds or feeder fund fund also has some fees at that level. And so sometimes they'll make it to where they're getting a good enough deal that it somewhat offsets the costs.
Right. So hold on. Let's again flip that. So there's the feeder fund and the fund of funds. So in my mind, it's totally something different. Let's focus for a second on the feeder fund. And so a feeder fund is basically the main example or use case of a feeder is getting together multiple investors to reach the minimum required to invest in a big fund, or diversifying across multiple people who don't want to put the minimum ticket. It doesn't have to be big, right? It might be $100,000, but 10 people want to do it together. So one person will basically build a feeder, which can be in the form of an SPV or an LLC or whatever that vehicle is, that people get together and invest together into a specific fund or syndication even, right? And so in that situation, in the situation of a feeder fund, there's the organizer of the feeder, right? And that organizer, usually when they come to that fund to bring multiple investors under one roof to invest, that organizer would get either special terms for their investors or a part of the GP, meaning a cut from the profits, right? They're not always going to get a fee. So there's not going to be double fees on a feeder fund usually. There's just going to be a bigger cut for that organizer because they organize all this money to be pulled into one, right? That's what I've usually seen in feeder funds.
Yeah, it could be. For example, I mean, I am involved in a feeder fund. And so with ours, they're used to getting check sizes their minimum check size is $1 million. And you can't even talk to them for less than that. Their normal check size is probably 10 million, and they sometimes get $50 million checks. So me coming in at 1, 2, 3 million, I don't get any sort of special treatment. I'm still a small fish. So for me, with this fund, what we did is there is an extra set of fees because we need to be able to be compensated because there was a lot of expense with the lawyers and all that kind of stuff to set this up. And so then what we did is basically have an asset management fee and then a small carry fee on the profits to be able to benefit from it. And so for that case, if you could write the $1 million check, you would go direct because then you would avoid those secondary fees. It's just the people that are investing, they really like the investment, but they want to put in 100,000 or 200,000. They don't want to put in $1 million.
That's a really good distinction, and I like it. And it's also important to emphasize why, because there's a lot of work that goes involved in being that organizer, not just from like the logistics of putting it together, but also the ongoing reporting of it, right? Because even from a K1 perspective, you as the organizer get one K1, and then you have to prepare multiple K1s for everyone. And
expense every year for that. With this one in particular, we spent 6 months investigating this fund before we went, and we sent people to the offices in New York and the offices in California, and we tracked down and talked to their auditors, and we, interviewed companies that they owned. And, there's a lot of due diligence and time goes into it. Then there's all the lawyering and all that kind of stuff, and then the ongoing fees that way.
Right.
But you're right. Many of them will do that where they'll say, what you'll see is sometimes the splits on an investment, it's 50,000, 200,000, $1 million or something like that. And there's different levels. Maybe you get a 6%, 60-40 split if you go in at 50,000, and then you get a 7% prof and a 70-30 split if you go in at, say, 250,000. But if you go in for $1 million, maybe you get an 8% prof and an 80-20 split. And so what people will do sometimes is they'll say, hey, I'm going to create a group and we're going to bring the $1 million so our group can get the 8 prof, 80-20. And then that person maybe offers everyone, even though they're only coming in for like 50 or 100,000, maybe they give them the 7 prof, 75-25 or something. And then in that case, they're keeping 1% of the prof for themselves and 5% carry for their profit, basically, to be able to set that all up. You as an investor in it are actually getting a better deal than you could get on your own unless you brought $1 million check.
Right. Okay. And then the last term that we've also heard, and we also spoke about it now, is what's called the fund of funds. And I'll just talk about it for a minute and then get your input on it as well. So a fund of funds, the way I see it, is there's a fund, there's a GP who raises money, whatever how much it is, with a target to deploy that capital across multiple funds, right? So I'll raise a $10 million fund to invest in other funds that have their own diversification within them, right? So they might be deploying across multiple assets, each of them. And so what that achieves basically gives me the ability to, as an individual investor, to invest a $100,000 check, which essentially is then diversified across 20 other funds that then are diversified across multiple assets. And that sort of like achieve this ultimate diversification. And that's what you're talking about. I think that's always, double fees. but it also might give you great exposure to like the big funds. And there might be their own, like that fund of funds might act for some of them as their own feeder within the fund because they have this large amounts of money that they can, invest the larger checks into a specific fund. And I think it's really important because I think a lot of people confuse between the fund of funds, which is like double diversification, as opposed to a feeder fund, which is single diversification usually, right? Because you're investing into one fund that might be across the single deal is like zero diversification, right? So that's how I look at these like three different levels of.
Yeah, the only way it offers diversification is you're allowing yourself to get exposure to something that you couldn't otherwise. And so there's a reason that you as an investor think that, I want to be able to get into this crypto fund that has a big minimum, or I want to get into this private equity fund that has a huge minimum, or I want to get into something. There's some sort of a thing, and that's the diversification. It's not on that particular deal, but it would be you on your overall portfolio would say, I'd like to get some exposure in this space. I can't do it on my own with the check sizes that I write. And so I'm going to do it through a feeder.
Yeah. And then if I want to do that at scale and I don't want to even select different feeders, I want to just select the manager of the fund of funds who will then diversify across different types of feeders in a sense, or different types of funds underneath it.
Yeah. Even with that, there's two things out there. For example, there's a couple I can think of. One of them, it's a crypto fund that they raised 10 million and they're going to put it's $1 million minimums to get into these different things. And they're going to take 10 different crypto related managers and that maybe are involved in some sort of like altcoin or picks and shovels for the industry or different things like that. And they're picking different managers, but each one of them, you couldn't get into it, that one investment without having $1 million, and they're going to get you into 10. And so you're getting very diverse exposure to something you couldn't get you give them 100 grand and now you've got 10,000 in each of these different funds that normally is $1 million minimum. That's one way of getting some diversification, but it's specialized and you know exactly what you're getting. The other that I see is look, we're opportunistic. Give us basically all of your money and we're going to put it into mobile home parks. We're going to put it in parking lots. We're going to put it into self-storage. We're going to put it into multifamily. We're going to do some preferred equity and we'll find the best things out there and give you that diversified portfolio. So you could just say, hey, I have $1 million that I'm investing and I want to have 10% of that in kind of this alternative space, but I don't want to try to figure it out myself. So then you can write them one $10,000 or $100,000 check. And they'll spread it out for you and get you invested across the board. And so then you can be invested in one thing and kind of have massive exposure.
So basically what you're saying is there's, just to clarify, so there are two fund-to-fund models in your review, and it makes sense. One is where you invest in a fund that diversifies across other funds. The second is you invest in a fund that diversifies across other single assets, but through other managers. They're not their own manager, but other managers that do single deals.
Yeah, it's another manager doing it. So you got your fund manager is picking the manager to go into.
So it's basically, as per this whole conversation, it's not fund to fund per se, because it's like a fund of single deals, single managers. But I think it still falls for me under the umbrella of the fund to fund model, because you are writing one check to some fund manager who's then looking for other managers to invest in. All right, cool. I mean, I can go on and have a lot more like stuff about, hedge funds and private equity funds, but I think we're going to end it there. I think that was in a really interesting, rundown and like aligning all of us on the terminology of single deal or single asset deal, a feeder fund and a fund to fund. And that's really important to understand the difference between each of those. When we go through these pitch decks, we don't necessarily pause or dive into that because we really want to get through the meat of the pitch deck. And so it was important to spend this episode on focusing on just like clarifying those topics. Anything you want to add, Mike?
No, I think you did great.
All right, cool. Well, thank you again for joining us, and keep on following us to get more insights on how to invest better. And until next time, invest smartly. See you next time.